Dear viewers, in this lesson we will discuss regarding the recent developments in insurance laws in India. The insurance industry has undergone numerous transformations in terms of new developments, modified regulations, proposals for amendments and growth. These developments have opened new avenues of growth for the industry while ensuring that insurers stay relevant with changing times and the latest digital disruptions. Let us first look at the Insurance Laws Amendment Act 2015. The Insurance Laws Amendment Act 2015 received the assent of the President on 20th March 2015, replacing the Insurance Laws Amendment Ordinance 2014, which had come into force on 26th December 2014. The Amendment Act of 2015 paved the way for major amendments in the Insurance Act 1938, the General Insurance Business Nationalization Act 1972, and the Insurance Regulatory and Development Authority Act 1999. It removes the archaic and redundant provisions and incorporates provisions providing Insurance Regulatory and Development Authority of India with the flexibility to discharge its functions more effectively and efficiently. The significant reforms introduced by the Amendment Act of 2015 are: firstly, enhanced foreign investment. It provides for the enhancement of foreign investment cap in an Indian insurance company from 26% to an explicitly composite limit of 49% with the safeguard of Indian ownership and control. Secondly, capital availability. It enables capital raising through new and innovative instruments under the regulatory supervision of IRDAI. The public sector general insurance companies are now allowed to raise capital subject to the government equity not being less than 51% at any point of time. Consumer welfare. Further, the amendments enable the interests of consumers to be better served through provisions like those enabling penalties on intermediaries or insurance companies for misconduct and disallowing multi-level marketing of insurance products in order to curtail the practice of mis-selling. The amendment law has several provisions for levying higher penalties ranging from up to rupees 1 crore to rupees 25 crore for various violations including mis-selling and misrepresentation by agents or insurance companies. With a view to serve the interests of policyholders better, the period during which a policy can be repudiated on any ground is confined to 3 years from the commencement of the policy, and after that period of 3 years, no policy would be called in question on any grounds. Empowerment of IRDAI. The Act entrusts responsibility of appointing insurance agents to insurers and provides for IRDAI to regulate their eligibility, qualifications and other aspects. It enables agents to work more broadly across companies in various business categories, with the safeguard that conflict of interest would not be allowed by IRDAI through suitable regulations. IRDAI is empowered to regulate key aspects of insurance company operations in areas like solvency, investments, expenses and commissions, and to formulate regulations for payment of commission and control of management expenses. It empowers the authority to regulate the functions, code of conduct of surveyors and loss assessors. It also expands the scope of insurance intermediaries to include insurance brokers, reinsurance brokers, insurance consultants, corporate agents, third party administrators, surveyors and loss assessors and such other entities as may be notified by the authority from time to time. Further, properties in India can now be insured with a foreign insurer with prior permission of IRDAI, which was earlier to be done with the approval of the central government. Health insurance. The Amendment Act defines health insurance business inclusive of travel and personal accident cover and discourages non-serious players by retaining capital requirements for health insurers at the level of rupees 100 crore, thereby paving the way for promotion of health insurance as a separate vertical. Promoting reinsurance business in India. The amendment enables foreign reinsurers to set up branches in India. Reinsurance may be understood as the insurance of part of one insurer's risk by another insurer who accepts the risk for a mutually acceptable premium. It excludes the possibility of 100% ceding of risk to a reinsurer, which could lead to companies acting as front companies for other insurers. Strengthening of industry councils. The Life Insurance Council and General Insurance Council have been made self-regulating bodies by empowering them to frame bylaws for elections, meetings, and levy and collect fees, etc. from its members. Inclusion of representatives of self-help groups and insurance cooperative societies in insurance councils has also enabled to broad base the representation on these councils. Robust appellate process. Appeals against the orders of IRDAI are to be preferred to the SAT, as the amended law provides for any insurer or insurance intermediary aggrieved by any order made by IRDAI to prefer an appeal to the Securities Appellate Tribunal. These amendments incorporate enhancements in the insurance laws in keeping with the evolving insurance sector scenario and regulatory practices across the globe. The amendments enable the regulator to create an operational framework for greater innovation, competition, and transparency to meet the insurance needs of citizens in a more complete and subscriber friendly manner. The amendments are expected to enable the sector to achieve its full growth potential and to contribute towards the overall growth of the economy and job creation. Now, let us understand some of the significant amendments introduced by IRDAI. Pursuant to the commitment of Insurance Regulatory and Development Authority of India (IRDAI) to facilitate insurance for all by the year 2047, it has introduced 3 significant changes in the regulatory framework applicable to insurers with effect from 5th December 2022. Broadly, these are intended to increase the ease of setting up insurance companies and reduce the burden of compliance for investment. IRDAI Registration of Indian Insurance Companies Regulations 2022. It came into effect on 5th December 2022 and has replaced the erstwhile regulations of 2000 and the IRDAI Transfer of Equity Shares Regulations 2015 with the revised registration regulations. The revised registration regulations regulate the registration requirements for underwriting insurance business in India and changes in the ownership of the same. These regulations will be subject to review for a period of 3 years from the date of issuance. Some of the key changes introduced by the revised regulations are: subsidiary company is now permitted to become an Indian promoter subject to specific conditions, that is, it must be listed on a recognized stock exchange, it shall have its own source of income, and must have a net worth of at least 500 crore rupees. Also, it must be noted that a holding company of such subsidiary must not be a subsidiary of another company. Investments made by a promoter or an investor would be logged in for a period of 5 years from the date of registration of the insurer. For investments made during a period of 5 years post the date of registration, a lock-in period of 5 years from the date of investment or 8 years from the date of registration, whichever is earlier, will be applied. The threshold on holdings has been revised. Investors can hold individually up to 25% and collectively up to 50% of an insurer's paid up equity share capital. A restriction regarding the source of investment has been introduced. Investments in an insurer cannot be made from borrowed funds. Investment as a promoter by private equity funds is now allowed directly, and the requirement of a special purpose vehicle SPV has been removed. However, such investments will be subject to additional conditionalities. In case of investments through a specific purpose vehicle, certain specific compliances requirements have been introduced, including that the SPV does not issue any convertible instrument or stock options or sweat equity. Transfer of shares of the SPV will be subject to the IRDAI approval. Promoters may dilute their stake below 50%, but not below 26%, provided that the insurer has a track record of solvency ratio above control level for the immediately preceding 5-year period of such dilution, and the shares of the insurer are listed on an Indian stock exchange. Investors can invest in any number of insurance companies, subject to each of such investment being capped of 10% of the paid up equity capital of the respective insurer. If the investment exceeds 10%, but it is under 25% of an insurer's paid up equity capital, then the investment by the investor will be restricted to a maximum of 2 insurers in each class of business. Apart from this, one-time investments made by investors into an insurer will have to be disclosed upfront and will require the promoter to undertake to infuse capital to meet its solvency and business requirements arising in future. IRDAI Other Forms of Capital Regulations 2022. IRDAI on 5th December 2022 has replaced the IRDAI Other Forms of Capital Regulations 2015 with the IRDAI Other Forms of Capital Regulations 2022, which regulates the issuance of preference share capital and subordinate debt by an insurer. These regulations will be in force for 3 years unless they are reviewed earlier. The key changes that are introduced by these regulations are: the requirement of prior IRDAI approval for raising other forms of capital has now been removed. An insurer may exercise a call option without the prior approval of IRDAI after 5 years of such issue of securities, provided that after the exercise of the call option, the solvency margin of the insurer is not at least 20% above the prescribed control level of solvency applicable to such insurer. The cap for raising other forms of capital has been increased from 25% to 50% of the paid up capital of the insurer, subject to an overall cap of 50% of the net worth. An insurer is not permitted to invest in other forms of capital issued by another insurer with a common promoter. IRDAI Insurance Intermediaries Amendment Regulations 2022. IRDAI has also amended the Insurance Regulatory and Development Authority of India Registration of Corporate Agents Regulations 2015 with effect from 5th December 2022, thereby increasing the number of insurers that a corporate agent can have agency agreements with. Now, the corporate agents registered specifically for a class of business like life, health or general insurance can have arrangements with a total of 9 insurers as against previously permitted 3 insurers. Further, a composite corporate agent can have arrangements with a total of 27 insurers without sublimits, as against the earlier limit of 9 insurers with sublimits of 3 insurers per class of business. Now, let us understand some of the significant amendments made to the area of motor vehicle insurance. In order to address the problem of road accidents and various other issues such as road safety, road discipline, compensation for victims, vehicle health, third party insurance, etc., the Motor Vehicles Amendment Act 2019 was enacted, and it has come into force with effect from September 1st, 2020. The central government has notified the sections 50 to 57 and 93 of the Motor Vehicles Amendment Act 2019 with effect from April 1st, 2022. Sections 51 to 57 of the 2019 Amendment Act wholly replaced the Chapter 11 of the Motor Vehicles Act 1988, which dealt with insurance of motor vehicles against third party risks. These provisions also made substantial amendments to sections 163, 166, 168 and 169 of the MV Act 1988 in relation to the filing of claims before Motor Accidents Claims Tribunal. Section 161 inserted to the 1988 Act via section 50 of the 2019 Amendment Act provides for increased compensation in cases of hit and run. Some of the major changes introduced by the 2019 amendment with respect to insurance and claims are: enabling insurer to seek exoneration from liability for non-receipt of premium. The amendment makes non-receipt of premium one of the specified conditions which would enable the insurer to seek exoneration from the liability. Limited liability in no fault cases. The section 163A is replaced with section 164, and the structured formula system of payment of compensation envisaged by section 163A of the earlier act on the basis of second schedule is repealed. The second schedule is also sought to be taken away. This provision contemplates payment of rupees 5 lakhs in cases of death and rupees 2 lakhs and 50,000 in cases of grievous hurt. Newly added proviso in section 165 subclause 1 states that acceptance of payment of compensation under section 164 will result in lapse of claim petition. Therefore, the maximum amount a claimant can get on no fault basis is rupees 5 lakhs in case of death and rupees 2.5 lakhs in cases of grievous hurt. Time limit of 6 months for filing claim. The section 166 subclause 3 states that the claim petition has to be filed within 6 months of the date of accident. In the original act passed in 1988, there was a similar provision, but the said provision fixing time limit was deleted as per the 1994 amendment. Therefore, a claim could have been filed at any time without any limitation. However, now that provision has been brought back and a limit has been fixed. Survival of claim to the estate of claimant after his death. As per the present law, a claim for personal injury would abate on the death of the claimant and would not survive to his estate due to the operation of section 306 of the Indian Succession Act. The claim would survive to the estate only if death had nexus with the injuries, and only in such cases the legal heirs would be entitled to come on record and continue with the prosecution of the claim. The amendment remedies the situation by incorporation of section 166 subclause 5 with a non-obstante clause, which says that the right of a person to claim compensation for injury in an accident shall, upon the death of the person injured, survive to his legal representatives irrespective of whether the cause of death is relatable to or had any nexus with the injury or not. Hit and run scheme. The compensation payable for victims in hit and run out of the scheme fund under section 161 has been enhanced to rupees 2 lakhs in case of death and rupees 50,000 in case of bodily injury from rupees 25,000 and rupees 12,500 respectively. Motor Vehicle Accident Fund. The Amendment Act introduces a Motor Vehicle Accident Fund under section 164 capital B, which is to be augmented by a special tax or cess. The fund is to be utilized for giving immediate relief to victims of motor accidents and also hit and run cases. The compensation paid out of the fund shall be deductible from the compensation which the victim may get in future from the tribunal. Now, let us look at the proposed Insurance Laws Amendment Bill 2022. The Government of India through the Department of Financial Services, Ministry of Finance, is proposing extensive amendments to the Insurance Act 1938 with a view to enhance insurance penetration, improve efficiency and enable product innovation and diversification. The department has published an office memorandum dated November 29, 2022, setting out the proposed amendments to the Act and commenced a process of public consultation on the proposed amendments. The Insurance Laws Amendment Bill 2022 is seen to be catering to the long-standing demands of the industry and seeks to improve some of the fundamental tenets of the Act. The primary focus of the amendment bill is on enhancing the financial security of the policyholders, promoting policyholders' interests, improving returns to the policyholders, facilitating entry of more players in insurance market, leading to economic growth and employment generation, enhancing efficiencies of the insurance industry, operational as well as financial, and enabling ease of doing business. The draft bill proposes various changes such as opening up the IRDAI registration to various classes, subclasses and types of insurers with minimum capital requirements based on the form of business as may be specified by the IRDAI, allowing insurers to additionally perform services that are incidental or related to insurance business as well as distribution of other financial products as may be specified by the IRDAI. Further, certain amendments have been proposed in line with the changes made to other legislations such as Companies Act 2013 and regulations issued by the IRDAI. The bill also proposes to introduce various significant changes to the existing insurance statutory framework in India. Dear viewers, I hope that you have understood the recent developments to insurance laws in India.